How to reduce income that is taxable. 1. Contribute to 401k. Reduced taxable income results in lower tax bills, and 401ks are a popular way to do so. The IRS does not tax money that you direct from your paycheck to a 401k. You could have deposited up to $19,500 per year into an account in 2021. This increases to $20,500 in 2022. Contribute an additional $6,500 in 2021 and 2022 if you are 50 or older. Employers typically sponsor these retirement accounts, but self-employed individuals can open their own 401ks. Additionally, if your employer matches a portion or all of your contribution, you will receive free money. 2. Contribute to a Roth IRA. Contributions of up to $6,000, $7,000 for those 50 and older, to a traditional individual retirement account, IRA, in 2022 and 2021 qualify as a tax deduction. Taxpayers who have employer-sponsored retirement plans, or whose spouses do, may be able to deduct a portion or all of their traditional IRA contributions from taxable income, depending on their income. The deduction for IRA contributions is phased out at various income levels, higher in 2022 than in 2021, depending on whether the deduction is claimed on a single taxpayer's return, a joint return, or a married individual filing separately return, as well as any other plan participation by the taxpayer. 3. Health Savings Account, HSA. Employees who have a high-deductible health insurance plan may reduce their taxes by contributing to a health savings account, HSA. As with a 401k, payroll deduction contributions to an HSA, which may be matched by the employer, are excluded from the employee's taxable income. However, an individual's direct contributions to an HSA are tax-deductible at 100%. For 2021, the maximum deductible contribution for an individual is $3,600 and for a family is $7,200. 16. These maximums will increase to $3,650 for individuals and $7,300 for families in 2022. 17. These funds can then grow tax-free. Additionally, when an HSA is used to pay for qualified medical expenses, withdrawals are not taxed. 4. Pursue capital gains over a long period of time. Investing can be a critical component of wealth accumulation. Another advantage of investing in stocks, mutual funds, bonds, and real estate is that long-term capital gains are taxed more favorably. Investors who hold a capital asset for more than a year benefit from a preferential tax rate of 0%, 15%, or 20% on capital gains, depending on the investor's income level. If the asset is held for less than a year prior to sale, capital gains are taxed at ordinary income rates. Understanding the difference between long-term and short-term capital gains rates is critical for wealth accumulation. For 2021, a married couple filing jointly would pay no tax on long-term capital gains if their taxable income is less than $80,800, or less than $40,400 for a single individual. For 2022, the zero-rate bracket on long-term capital gains applies to taxable income of married couples up to $83,350 and single individuals up to $41,675. 5. A tax planner and investment advisor can assist in determining the optimal time and manner in which to sell appreciated or depreciated securities in order to minimize gains and maximize losses. By selling securities at a loss, tax loss harvesting can also be used to offset a capital gains tax liability. When capital losses exceed capital gains, the greater of $3,000 or the net capital loss may be deducted from other income. Capital losses in excess of $3,000 are carryover to subsequent tax years. 5. Go ahead and establish your home office. A woman working in her home office, her feet propped up on her desk, while conversing on the phone. If you use a portion of your home regularly and exclusively for business purposes, you may be able to deduct some costs that would otherwise be considered personal expenses, such as a portion of your utility bills, insurance premiums, and home maintenance costs, as home office expenses. Some home-based business owners avoid taking advantage of these tax breaks out of fear of an audit. However, the IRS has simplified the process of claiming this tax break. Rather than itemizing your expenses, you can claim a standard deduction of $5 per square foot of office space up to 300 square feet. Nota bene, if you were an employee who maintained a dedicated home office as your primary place of business. Your ability to deduct those expenses has been eliminated under the new tax law, which eliminates miscellaneous itemized deductions.